Thanks for tuning into Alpha Moguls, a show where we speak to some of the finest investing minds about what is their approach to their portfolio construction under the current landscape. Our guest today is Prateek Agrawal. He runs arguably one of the largest private portfolio management practices in the country. And Prateek, great having you on the show.
Thank you.
Prateek, just to get the basics going, what has been your approach to portfolio construction over the years? And just wondering if the current thesis that you have for your portfolio construction is different than the past, simply because the world that we are living in currently seems to be a lot more cyclical, a lot more fragile, and a lot more volatile.
Sure. So we are a house that sticks to its investing philosophy. We don't change it. We may tune it a bit for the time, but we don't change it. We seek to deliver preservation and growth to our investors. And towards that goal, we invest in high quality free cash flow generating businesses, which are able to grow over, let me say, 3 to 5 year kind of a time frame. So practically all businesses have an element of cyclicity in them. It is not that any business is a perpetual growth business, but there are businesses which are longer term secular growth basis the tailwinds they may be experiencing in a period of time. We wish to be with those kind of businesses, and if I may just say, some of the best businesses in those spaces.
Okay, so you've never had, or you've not had too large a temptation, for example, to log into cyclical businesses because the valuations present in the case, even if you thought that this may last only for 6 to 9 to 12 odd months, a case in point being, say, metals in 2020, or select other cyclical spaces that may have been up there.
No, so yes, the valuations were low, they were enticing, but how we address that issue is by communicating to our investors that this is what they should expect out of us, and this is not what we would do. So if in the beginning that's been made clear, the path for us investment team is very clear, and we then stick to the path that we have communicated. So that is something that our investors value. Sticking to the plan, it results in lower volatility portfolio, something that people like with us.
Yeah. Okay. So I presume that's what's helped you make money, and therefore you don't see much reason to change that, even in a post-pandemic world, which is and a world besotted with geopolitical stress. You still believe that is a winning formula.
Yeah, that's a winning formula. But like I said, because of the changes that may be happening globally and in India, there may be new themes emerging. The earlier themes will be running their course. So we do change, we do include the newer themes where longevity of growth is there to be seen, where richness of businesses is there, and then ride it. Let me just say this, we run today around 20 stock portfolios. 23 stocks is there in the largest portfolio that we run. 9 out of those names have been there with us for over 5 years, or thereabouts. So that gives you, so while we may have tweaked the percentages and all of that, and these names may have multiplied and they continue to do well, but the names themselves have been there. If you look at our investor base, something similar would be seen in the investor base itself. People come to us and stick with us for a long period of time, and they have seen this happen. So very few changes, 3 to 4 in a year, rebalancing, that is all that we do. And the newer themes get included. The earlier themes which may have run their course may get trimmed down or excluded, because we want to maintain tight portfolios, not make it very long.
Got it. Okay, I'll come to themes in a moment. First, let me get your macro view, Prateek. The overarching view is that the market is slightly ahead of its long-term valuation metrics, few standard deviation above certain metrics that people choose to look at, much more expensive. India, much more expensive compared to the world. But select markets which are doing well are anyways looking a bit more expensive in light of the fact that We are in a world where interest rates are moving up, wherein there is quantitative tightening and geopolitical stress. So are you fully invested currently? And if so, how do you align your thought to stay fully invested in light of all of these uncertainties that we have currently?
Sure. So, taking the last one first, we always are fully invested, except for the period when we are selling something to buy something else. And, in our system, you need to raise cash before you can deploy. Can't happen simultaneously. So on a day or two, you may see some cash, but otherwise, no, we stay fully invested. One big reason for taking cash calls, to my mind, is to dampen the portfolio. A high beta portfolio, if you take a cash call on the way down, it will dampen performance. Dampen performance meaning it won't fall as much as the fall in the market, and that helps the fund managers. If you look at our portfolios are low beta historically. If you buy steady, strongly growing businesses with less variation in profits, the that element which causes volatility itself is less there, and hence in not so good periods, we tend to do mostly much better. So over last 11, 12 years, there have been just 3 instances when we may have fallen more than the market in a large market fall. So our need to raise cash to dampen the move down is also not there. And I tend to see cash as a source of risk as well. Raising cash, there has to be a thesis behind it. That thesis does not change at the bottom of the market. Okay, and most managers, most individuals, most investors who raise cash would end up deploying cash at levels higher than where they have. If not in one instance, but over multiple instances, almost definitely. And hence, taking cash calls is to be seen as a source of risk. It looks good for a period of time. It almost always hurts performance. Now, coming down to your first bit, geopolitics and all of that, a lot of it is very good for India as a country. So, if there are, let's say one country flexing muscles versus the US, US wants to diversify business to other countries. We are one the line, we benefit. Okay, if two countries fight with each other, suddenly the make in the country, we always said make in India, but make in the country becomes a global theme. And when somebody then tries to give protection to their own businesses, it is not frowned upon in the manner that it used to be just before COVID. Okay, so that again gives a lot of strength to Indian businesses. And it is not an accident that you see a lot of positivity towards doing capex in the country, because businessmen are seeing profit, they are seeing ability of the government to defend the business, and margin sustaining for longer. So a lot of things happening globally is a huge positive for us. I think it helps that we are also learning to not dabble too much in geopolitics and do business. So if two people fight, theoretically it is good for everybody else who can do more business. And that is what our chaps have really communicated well. And markets are celebrating all of that. In terms of business outlook, in many ways, hence, we are better off than where we had been over last 10 odd years. Okay, if you segment the last 10 plus years into two halves, the first half, you would see margins of corporate India falling. And that was the period when bank bad loans were getting recognized. That was the period when globalization was at its peak and you were having to drop import duties. Chinese competition was so high. You saw decimation of several Indian businesses just because Chinese thought they would want to manufacture it. Now that's changing very, very sharply. Bank loss recognition is behind. Bank profits are up. Credit growth did fall in between. Now it is again rising up. And margins are ticking up. even next of bank margins are ticking up. So there is this change that one is seeing, plus the outlook. After 2003-4, we are looking at capex not being a drag on the economy, but being an engine of growth. Government was always doing it. Private sector has started to do it. Even households have started to buy housing. So all three engines coming together, and that really helps. It's not something which starts and stops quickly. If it happens, it gives some tailwinds to consumption as well. So I think lots to look positive to and be overall positive. So if somebody is a growth investor globally, there are not too many places you can invest into. Large geographies, USA, Russia, Europe, not growing. China slowing down. Japan not growing. Uh, our subcontinent, apart from India, not growing. Middle East growing. Commodity countries still growing because of commodity tailwinds, but very very shallow few companies kind of markets. So if you are a global investor also and you want growth, if your philosophy is growth, then choices are limited. So coming down from there to valuations, yes, today because of this, we may be looking at better than other emerging markets. My thought is that we are fine basis our historical valuation matrices, such as PE. No point in looking at very long period PEs because the makeup of the index itself has changed. If you look at what is there in the index, and we did a slide on that, in 2002-3 kind of a period, the cheap part of the index used to be closer to 40%. Commodities, government kind of stuff. The more expensive part on PE, the high PE part of the market, consumers, insurance, private sector, financials, etc., are retail companies are now close to 50%, and they will sustain there. If that thesis about richness of business and longevity of growth is playing out, it will probably sustain there. So if you look at last 10-year kind of PE averages, we are there. On some periods, we may see a tad lower. On some periods, we may see a tad higher, because this 10-year period actually had a COVID low and another deep dash. So that makes the averages a bit different. But 18 and a half are sustainable numbers 1 year forward. So with index EPS expected to be, I would say, closer to 950, 960 kind of a level in 2024, I think we are at sustainable levels on PE. As far as our own history is concerned, if you look at bond yields to earnings yield, I think that's a parameter that is clearly pointing to some amount of discomfort on equity valuations. Bonds being where one should be. There, which is why we say expect a period of consolidation in the market as we go forward. Let's say quarters at similar levels, that again should take care of itself. Or commodity prices reduce, and that results in yields dropping, bond yields dropping. So that's the combination. But given what we are seeing, we don't expect a large correction at this juncture. I think this is the time to keep faith. What is also happening and is unique to India is that if I just make that comparison, for the same reason that people start to buy more cars or buy more air conditioning, is the reason why people also buy more stocks. The reason is they have more money. So as you grow up in per capita, you move over, roti kapada makan kind of key issues, and the quality of life starts to improve, and you start to spend for that, and the ability to invest rather than save improves, which is why money flows into equity increase either on your own account or through funds. We believe we are seeing a very secular trend there, yes, it won't be without hiccups for sure, but a very secular trend, and which means in this kind of a phase, uh, we are a very good buy on dips kind of a market. So
Okay.
yes, as things as globe normalizes, countries which may not have done so well will do better or hope to do better. But that doesn't mean we fall. We may just do a tad less, and hence the valuation differential which may have come up may reduce. So let's see.
Got it. Just one more macro question out here, Prateek. You have a very large size. You must be speaking to global investors into your funds or global investors in general who are of your size or maybe even bigger than you. Is it a prudent time to be a growth investor, or is it prudent time to be a slightly defensive investor? Again, getting back to the same point about how fragile the world seems to be currently, both on geopolitics as well as on liquidity, if indeed higher interest rates as well as quantitative tightening is to be thought of. I mean, you can't take away the fact that we are in a higher interest rate scenario, probably for the first time in many decades.
Not true. So if you look at 8 months of successive selling that we experienced, it was that kind of a period when there was prospect of liquidity tightening, there were prospects of interest rates moving up. And if you look at other geographies in the same period, it was not as if they were getting outflows. So many of the commodity producing countries, the value kind of markets got inflows in the same period. The growth market got a huge amount of outflows, and we saw what we had never seen before, 8 months of successive outflows. Now, if you look at, track that and see when it changed. Okay, trade changed in the month of July. And that was the period when you started to see commodity price drops. Okay, oil may be at that lesser, but every other commodity, be it steel, aluminum, copper, agri commodities all started to drop, and they have continued to drop. Even oil from the peaks has dropped. Okay, and with it, bond yields have also dropped in India for different reasons, in the US as well. So 10-year US peaked at the not the last rate increase, the rate increase before at 3.4, fell to 2.7. Again, with the rate increase and tightening and everything, has come back to 3.3, 3.4. So now the rate increases are not having the kind of impact they used to have before. The thought is that unless you do an increase which is not on the expected lines, maybe the 10-year is discounting. Maybe if it exceeds those levels, then I think we should be expecting another round of selling, because it will also coincide with dollar tightening, etc., etc. We should be prepared to expect another. And worse, if, for example, oil shoots up. So as we speak, in the month of October, I think the strategic drawdown of strategic reserves should end. That may have provided some lift to the oil prices. Now, if that ends and we don't find more oil from elsewhere, and gold tries to grow, there are combinations. That's the other risk. If oil shoots up, I think we get hurt very bad. And like I said, again, the same combination which caused a lot of outflows from India will re-emerge. Now, commodities moving up, interest rates again, moving up on a rate increase surprise. So those are things one need to be watchful about for sure. Chances are also that this thing does not occur, because all said and done, the driving season is behind us. There is an attempt to increase oil production. Maybe we see a Venezuela or an Iran coming back to the market in a greater force, and we get some much wanted barrels to cool the oil prices down a bit. So, everything is possible. That's the market which hurts us the most. That is something we need to watch very closely.
Okay.
Also watch very closely, because we are losing forex at the rate of, let's say, $2 billion a week. Ceteris paribus, even if the defense of the currency kind of lead is not there. Given the trade deficit, given the surplus of the current on the services side, remittances, etc., all put together, the balance is $2 billion a week of lead. Today we are comfortable. We have one of the largest reserves of forex globally. We do not have too much of short-term debt to repay. All very good. But if this thing continues and we drop, let's say, 150 million more, and that would happen over a period of a year, given the pace that we are at just now, I think we need to keep an eye there. It will cause tightness in money supply in this country. It may also cause increase in interest rates here, increase the lending rates here, even if inflation has been conquered globally. That is something to be aware of.
Got it. Okay. So investors would do better to keep in mind all of that. So in light of all of these hypotheses, as well as the uncertainties, what is the portfolio construct currently, Prateek? Where are you most overweight? Where is it that you have change your stance from maybe you were overweight or maybe you were bullish and now you've taken things off the portfolio themes?
Yeah. So, if I take you back to the COVID period to now, in the COVID period, we were high with staples. So there was a context to that as well. We were positioned there and it helped us. Pre-COVID also growth was slowing down. And the thought was what will sustain the best is smaller ticket consumption items. Mostly of the essential varieties. So our portfolios had consumption, and within consumption also more of staples, 14-15% into staples. Now, as the recovery has started and the faith in the recovery has gotten stronger, we have moved consumption down a tad, more importantly, reduced staples and increased discretionary spends. Spending categories. So that's one change which has happened, and introduced themes that we are very positive about, such as chemicals, more into the portfolio, such as PLI beneficiaries, such as new age manufacturing in the country in a greater force. So manufacturing, for example, in our portfolio used to be close to zero for a long time. But now it is close to 15 to 20%. I mean, cement we always add. If I include cement in manufacturing, that's a big change that's happened. Defense has been a small part of our portfolio, done very well. Not a part of our major portfolio because most of the businesses there are not large. That's a theme again that we are very positive. So if you look at our portfolio, we have changed the consumption a bit toward overall within consumption, changed from staples to discretionary more. And then financials maybe moved up a tad. We are underweight financials versus the index by a large amount. So index is 35, we are 25-26%. Consumption is 25-26%. So put together, let's say 55% here. 20% is into chemical, pharmaceuticals, agri-chemicals kind of space. This is a space, mostly the specialty chemicals space that we see very long runway for growth, and that is strongly represented in all of our portfolios. 20%, like I said, is manufacturing. So earlier it used to be 5-6%. Now that's expanded materially. Tech companies, again, we are seriously underweight services. We just have 4-5%.
5%, yeah.
And we have a commodity stroke tech platform at another 5-6%. So that kind of makes up our portfolio.
Very interesting.
Some of the places that we have increased.
I get your point. Okay. Can I start off with the underweight position though? Banks. There is a consensus view that banking results over the course of the next 3 quarters, arguably over the multiple quarters, will stay very strong. Valuations are not astronomical. Why would you have an underweight stance?
So banks are a great place to be in. We have been very positive banks. So, we invest with, yes, an eye on the index, but we are not index others. No, that needs to be. So if I have 25, 26% into financials, we are very positive.
Okay.
No two ways about it. It is just that we don't want all the names. We have our conviction more in smaller ticket lenders than larger ticket lenders, and that is something we have retained. We had our good time. In between, when the corporate lenders did very well, we struggled a bit. Now I think both the given the evaluation, both have an equal chance of doing well, and our financials are doing quite well. In fact, if we look at the attribution analysis, you would find that while on financials we are lesser weighted, we have most of the names which are doing well, and on selection we are doing very well. So overall, if with 25, 26%, I'm getting as much bang for the buck as putting in 35%, I think we are very well off. Because if I need to put money into chemicals, which is simply not there in the index, I need to find it from somewhere. Similarly, IT, 15% in the index, with us 5%. And that's been an easier one. We see, like I told you in the beginning, long period, stronger growth. So IT is sustained growth, but I think now a more mature industry where sales growth should be around 10%, maybe a tad lower, profit growth of similar amount. This year will be stronger, next year should be expected to be weaker. So it does not fall into, the quality is there, the growth outcomes are lesser, and
Got it.
we have stayed lower that way. Again, finding money for our other thoughts.
Okay, just one quick follow-up. Non-lending financials, you've kind of steered away from there, because I heard you mention banks being the large dominant part of the 25%.
Non-lending, well, yes. We have reduced a tad. We still have a lot of insurance, both life and general. But we almost never had a brokerage, while they had a great time as well. We did have mutual fund exposure. We made money there. We got out in good time. Because they also experience some amount of volatility on margin reductions, etc. But we continue to be positive on this space. The service providers to the equity market, again, a space that we are positive about. We are tracking them, but they are not finding space in the portfolio.
So, but to ask you, if you believe that the theory of that more than $2,000 or a particular level per capita, people start investing in equities, how are you playing the equities theme? There has to be broking or AMCs, or maybe the ancillary plays. There has to be one of the three at least, right? So I was trying to ask you, what is there? Ancillaries?
No, so ancillaries are also not there. So yes.
How are you playing them then?
As of now, it is not represented in the portfolios, apart from, let's say, life insurance kind of businesses, where a lot of the business happens for actually equity investing itself. We are glued on to the space, no two ways about it. I can go on and on that. I think in one of our conversations, I had pointed out that we like mutual funds quite a bit.
Yes, because of the 10% annual appreciation.
We had invested, we were invested there. But then, a theme can deliver you growth, but valuations, if they catch up and go ahead of it, then you need to look elsewhere, which is what we did. And it's worked out. It's again on the radar. It's something that we focus very closely at.
Okay. Now, before I talk about your pet theme, and there are two out there, Prateek, I'll take 10 more minutes on the show if you're okay with it.
Yeah.
Okay. First, before I talk about chemicals and defense, which is how I'll end the show with, I want to talk about manufacturing, because again, there seems to be a consensus, and some people go far out as saying that if 2010 to 20 was a decade of B2C, maybe 2020 to 30 will be a decade of B2B. The SKFMD says that if I was a manufacturing CEO, I would be very happy. How are you approaching this bucket? Because some of the valuations of companies which are going to do well and is known are very high. So how do you go about doing this?
No, so you are right. I think the space is seen. So I'll tell you the struggle. Okay, if
Huh.
you believe that the space is deep cyclical, does very well when the economy comes back and
Yeah.
vice versa, then you won't be able to defend the current valuations. They are high. In fact, they were high to start with. Uh, and if you compete various themes which were happening in the market at that start point, and you were with chemicals or you were with, let's say, defense, you would have done as well, if not better. Or if you were with, let's say, even financials. So it's not something which alone has worked in this period. Okay, and I think that is one reason why we did look at the theme, but even our portfolios do not have representation from that. The other big challenge was lot of what is industrial in the country was very closely associated with coal-based power. And that seemed to be something which was getting behind us. Renewable was something which was less represented in the marketplace. But yes, other stuff, even renewable would need switchboards and all of that. It would also need power supply lines. So that segment of companies will do well, is fine. But then once again, the cyclical nature of the space would not justify the starting valuations that we saw there. And others were offering better. So we were somewhere else and did as well. Now the thing is, it may prove to be less cyclical. So if you are looking at this space just now, one will have to debate whether the cyclicity would be of the same order as before. Now, like I started by saying, every business is cyclical, but there are periods when a space can do well for longer. Uh, it just may be that since we are going about on our capex cycle, this space can do well for longer. And it can also do well for longer because a lot of the good names here are MNC subsidiaries, and many of them are facing troubles in their own
Hmm.
liquidity, and they may want to do more wherever they have subsidiaries. And India definitely is one of them, and we are very happy to do more. So that again is another theme that feeds in. So, but then as far as we are concerned, once again, we have looked at it. We have found valuations to be a tad higher than our comfort zone and hence not participated. Except, let me say, in cement, in PLI beneficiaries, in new age steel, equipment maker kind of, not construction stuff maker kind of stuff. So it is a 15 to a 20% weight in our portfolio, but we are not in the names like ABB, Cummins, Siemens, etc.
Got it. Pratik, defense seems to be a theme that has finally come of age. The conversations are very promising. How have you approached investing in this space?
Yeah, no, so this is something which is happening uh, strongly. I think the geopolitics of the day further feeds into it. Uh, we used to be the largest importer of arms globally, and indigenization of the same over time does provide an extra leg of growth. So suppose 8-9% is the growth in the budget. If the wage part of forces budget increase a tad lesser, you see the capex part increasing a tad more. And then if you indigenize a tad more, what you're looking at is a 11-12% of real growth, inflation extra. So because I just took 7-8% increase in the budget, not counting inflation. So this is a space that can deliver you 15+% CAGR growth for a period of time. If you engage with any large platform guys, So the platforms are, let's say, BEL, BDL, MDL kind of spaces. They will all talk about long period
Hmm.
sustained growth of this order. And once again, many of them are also doing civilian stuff. If they succeed there, a tad more. So the outlook is very strong, and then there is a level which is below. So the thing is, while the integrator, the system guys, platform guys will do closer to 15%, the guys who are a level below and supplying stuff to these guys are being developed. So they are the ones who are really benefiting from import substitution. And many of them may be growing at very high rates, very, very high rates. And that is in the private sector. So, small space, I think we have some exposure there in the private sector. We would have been happier with more, but the movement has been sharp. I think if the space consolidates a bit, if some of the outcomes which today are uncertain in terms of platforms which may happen, which may not happen. So, when the space is in flare up like it is at this juncture, everything that is talked about is seen as fait accompli, and people assume it will happen, but not everything is going to happen. So, if there is a period of consolidation, I think managers may just get breathing space to have more of it in the portfolios. But a
Got
very,
it.
very interesting space to look at. Long period growth ahead of many vendors in many spaces now. We were always seen as follower of technology. We used to be one step behind. So world goes for sixth gen aircraft. We are at four, going to 4.5 kind of stuff. But in many spaces, we are now getting there, cutting edge, especially in, let's say, radars. So, which is really exciting. If you look at what we are proposing to export to other countries in terms of aircraft, it will probably have Indian radars. And the newer versions of aircraft will again have Indian radars. It seems they are proving themselves to be as good as, if not better, in some manner versus imported ones. So this is really helping. Submarine, for example, the prisms that are there for what is it, periscope, used to be an import item. Now it is manufactured here. So these stories are nice. You hear them, you feel good. Gives a long runway to growth. I think we need to understand what all will happen with more certainty. Uh, this is a space that should keep finding legs, is what my belief is.
Okay. Before we wrap up, Prateek, this is a brilliant answer. I dare say I don't want to ask you about chemicals because this is such a good informative answer. But let me just end the show with that, because it is a pocket that a lot of people are present in. It's gone through a peak and a bit of a flux. I heard you mention that that's one of the two top themes that you have. Why do you like it so much currently?
So, very simply put, we are 3.7% of global production. Okay, this is a space which is growing at over 3% globally. And for various reasons, not too many people want to make more of it. So every company that you speak to in India is trying to double up capacity as soon as possible. Today, they are taking, let's say, 2.5 years to double capacity. And I dare say after 2.5 years, we will again see another round of similar doubling up of capacity. So 4 to 5 years of very strong growth is ahead of us, which at the end of it should take Indian market shares, closer to 10% versus closer to 5% that we have now. Uh, we made a point of lot of ability of the government now, increased ability to provide protection. Even otherwise, with rising wage cost in China, with higher focus on pollution control in China. The good thing is Indian business is now able to export to China. Some of the businesses that I met over last 2 weeks, made that a point. We export 10% of our production to China, 30% somebody said, and which kind of points to the fact that put the head down, think through it. We are able to do it at a good price. We are cost competitive. Government is able to provide a helping hand, and this is a space which does not have alternative. If you don't want to do it in China, we are the next best ecosystem. Malaysia is starting to come up, but I think way behind us. So unless we really do something wrong, we have a great outlook for our guys here. Yes, they got discovered. They did very well. Then there is an element of commodity in chemicals. They have margins which move up and down. With higher oil prices, with higher input costs, various people benefited or lost out over the past period. But for a longer term investor, this is something that will keep happening. And if you identify these spaces well, I think this should prove to be, even from these levels, very strong return generator into the future.
Great. Prateek Agrawal, it was such a lovely last 40 minutes listening to you and learning from you. Thank you so much for your time today on Alpha Moguls. And look forward to many more conversations.
I look forward myself. Thank you so much.
Yeah, this was lovely. Viewers, thanks for tuning in to the first episode of the new season of Alpha Moguls.